afternoon, everyone, and welcome to our session. Capital markets is IPO and M&A activity increasing within the digital asset space. As the digital asset market is maturing, we are seeing a fascinating shift. IPO returning, M&A accelerating, and the lines between traditional finance and DeFi blurring. Please join me in welcoming my fellow panelists. I'd love for you to introduce yourselves briefly, please.
Hi, everyone. My name is Mitch. I'm a partner at Fifth Era. We're an investment firm in the space. We have a variety of strategies. The most prominent is fund of funds, probably some of the most prolific early-stage venture investors, having allocated approximately 50 early-stage venture funds. We're also pretty active in late-stage, increasingly more so in public markets. So glad to be here.
Hi, everyone. My name's Ryan. I'm a portfolio manager at Forteus, where we're building a FCA-regulated institutional asset management business focused solely on digital assets. We have two main products. I run a directional token picking fund, so investing in top 1,000 altcoins with Bitcoin and ETH. And the whole emphasis for what I do is really applying fundamental analysis with a VC mindset into a liquid kind of token space.
Hey everyone, James Newman, managing partner and fund manager at Republic, where I run our flagship venture fund.
I'm Jean-Malo. I'm a managing director at Stifel. I advise companies and founders and builders in their strategic journey in the digital asset space. I spend pretty much all my time on crypto and digital asset companies.
Thank you very much. Let's dive right in and let's start big pictures. So crypto companies started with ICOs, and 2025 we've seen a wave of digital asset firms going public. We've already seen 5 of them listing on traditional exchanges, and 3 of them are in talks, potentially going public. So why now? My first question to you, Mitch, what are the key forces and driver behind this increase in IPO activity?
Yeah, thanks. So it's actually a really exciting time because basically from November 21 to November 24, there were effectively no digital asset IPOs. And there are a variety of reasons. You had the SEC being quite hawkish under the Biden administration in the US, but effectively you had no bid for growth, right? It was very, very difficult, not just in crypto and blockchain, but in tech broadly to go public. And so what happened in 24 after the Trump administration won and this regulatory shift, there's sort of returned these animal spirits, at least in US public markets. And so we've seen very successful IPOs such as Circle, Gemini, Bullish, really start to show that there actually is a bid, particularly for our industry, in the public markets. And that's creating a kind of rush in the late stage private companies to access that capital. So it's the first time effectively since 2020, 2019, that the market really is wide open. The last time that happened, only Coinbase made it through. So now everybody is rushing to try to get to the public market, so it's a very exciting time. And then on top of that, you have this rise of DATs, which I'm sure we'll talk about and the other panelists can comment on. But it just goes to show that in the public markets, particularly in the US, there is a lot of interest now in our space, both for traditional equity corporate structures, but also for tokens.
Just on this, I mean, all those IPOs have been in preparation for 3 years now, and Gensler has stopped the process, and with him going away with the new administration, the process are much quicker, less challenged, and there is a broader group of eligible companies going public. The interesting thing is that during those past 3 years, those companies have actually grown their revenues, their perimeter, their clients. So now there are massively, and they're eligible to a size where they are meaningful in terms of size to be public. Because you need a certain size, and you needed the industry to grow and to get this player bigger in order to hit the 1 to 10 billion type of market cap in order to be meaningful in this market, which was not the case during like the past few years. Another interesting fact as well is that these IPOs are actually, are still priced decently, I would say, between 5 and 10 times the revenues, and then they shot up because of the scarcity of these assets and the appetite from investors to get an exposure to this developing industry. But the bankers are trying to stay shy on pricing, and that's the interesting fact I see in these dynamics.
But at least the banking side of stuff is back post the kind of regulatory clarity. At least the number of US banks stepped back into being able to actually offer IPOs, just in the same way that a number of digital asset companies got debanked. They weren't able to access funding, financing, or any kind of public markets. The latter point to make regarding why now is that if you look at venture capital vintages, especially 2021, there's been a serious lack of DPI, i.e. capital return to investors. And so there is this demand from the investors in some of these private companies to actually push them towards cynically, either going via equity routes or token routes into something that is monetizable.
And Jean-Malo, I actually wanted to ask you, you mentioned something kind of interesting, which is that they're pricing at 5 to 10 times revenue. How do the banking teams think about taking assets public where there are no exact comps, right? So you obviously have the exchanges, which they maybe look to Coinbase. But if you're a company that maybe is a tokenization infrastructure, what are the kind of conversations you're having? I'm genuinely curious.
That's a real issue for bankers to price those deals, actually, because you either have like infrastructure type of player or large fintech players at the comps, or the M&A comps, which have like 50 times revenue. 50 times the revenue. So you are navigating between this massive premium at 30, 50 times, and when you go to the market, you need to be decent and polite to the investor base. And at the end of the day, the market decides, so you're not taking much risk, and you're telling the founders and the companies that the market at the end of the day will price their company. So it's not a big deal if you underprice, because the investors, and we know that there is a strong appetite for this type of securities and companies, but you can't know if it's between 10 times and 50 times. Because of this premium that is driven by the strategic value and the scarcity, and you can't have a precise metrics on this. So the more we get companies public, obviously you get better comps, and it's gonna align everyone on certain pricing.
Thank you, Jean-Malo.
Actually, I have one thing to add.
Yeah, go ahead.
So I think if you zoom out, there's a natural kind of demand dynamic, and that's kind of bidding up these valuation multiples from public down into private. And that is basically, yes, the IPO markets are open for crypto, and that's been an explosion upwards, and there's going to be maybe 15, 20 more in the next 12 months. But from a investment fund flow perspective, most savings accounts can still not access Bitcoin. I'm in the UK. I cannot put IBIT in my savings account. I can't put it in my pension, and that's going to slowly change. Can Jean-Malo, can you put Bitcoin in your savings account?
Well, this relates more on the asset management side, but essentially this asset class is obviously getting extreme, but it needs to get to the final user, in a sense, which is the final investors and the retail investment base, and you need to include this in life insurance company, in 401ks, and that's how people will get to it and will understand it. And this is growing. It's too slow, but we see companies opening up those saving accounts to this asset class through. I mean, it's different in the US and in Europe, obviously. And there's a little bit more challenge in Europe because of the regulation and the usage that makes those saving accounts eligible to all the countries in Europe. But we see large asset manager like Amundi recently open up, and they were pretty shy on this yet, but they're going there, and once this asset class is going to the saving accounts, everybody will be exposed and will have an understanding of how it works, and the IPO market will be more visible as well, and there's going to be more IPOs coming in. Just a last word on IPO is that essentially, it's not dedicated to digital asset companies. The IPO window has opened for all companies, like throughout sectors. The tech sectors has been a focus and has been very intensive in terms of company going public. And we are biased towards digital asset company, but it's been the major play in the, let's say, fintech area. And this is pretty much the only area and segment where you can raise funds without being profitable. That doesn't exist outside of the blockchain-enabled services companies.
Thank you, gentlemen. Hold that thought for a sec, because we're going to dive deeper into that. Following question, why do so many digital assets firms choose to list in the US? And how are regulators like the FCA or the SEC or the Monetary Authority of Singapore influencing listing venue of choice?
Yeah, so I'm happy to take this one. I mean, from my vantage point, I think the key driver is actually capital. Right, I think that a lot of the companies would be sort of agnostic to listing venue, but if you go to the US, you can get a valuation premium on what you might be able to get if you list in Amsterdam or London or other venues. So I think that, above all, really drives a lot of those boardroom decisions, because you can raise more capital at more attractive terms. The second part of your question related to the regulation is definitely the SEC in the US was, as Jean-Malo noted, taking a long time, sometimes more than 2 years in certain instances like eToro, to run these companies through the S1 and S4 filing process, which is required to list in the US. That now has completely sped up, and the SEC is sort of waving these companies through. So I think the two combinations of that has made the US right now the sort of listing venue of the moment.
Absolutely.
But there's no guarantee that holds.
There's eventually going to be some kind of regulatory harmony. There has to be. Not to say that everyone's going to step on the same platform, but with the US acting how it is, the FCA, MAS, and other regulators will clearly be looking at the playbook as the Middle East is in terms of what ADX is allowing with SPACs. Reopening up those markets is incredibly important, and that regulation needs to be in place. As you mentioned, the S1 form can be very cumbersome. It can take a long time to complete. And the SEC previously were able to arguably make that process a little bit more difficult for those that were looking to list. It is really up to the individual regulators across Europe, the UK, and Asia to think about what they want, because going forward, a lot of companies are looking, even if they are domiciled in the UK or Europe, to list in the US. And that's an incredible shame for these continents.
Yeah, I mean, I completely agree. I think London in particular has really missed a massive chance.
Massively.
They basically had 4 years where you had Brian Armstrong and Coinbase touring London, saying maybe we'll re-domicile, and the FCA just never really got its act together. The FCA being sort of the main financial regulator in the UK. Now they're putting out reports and notices that they want to sort of modernize the listing process, potentially reduce stamp duty to make it more attractive for companies. The politics is starting to come into this. Nigel Farage spoke at a conference this week in London and sort of starting to champion this industry, politics aside. So it's definitely coming into the forefront. But I live in London, actually, been in London 10 years. So I really feel like London, we missed this one because the US was closed and we could have been open.
Is there still time?
I don't know. I mean, right now the U.S. is firing on all cylinders, but I do think there's a natural pull to London, right? I think that companies that have more of their client base, employee base, maybe even headquarter base in Europe and in London would probably, all things equal, prefer to list in London and have London-based investors. So there probably still is time.
London has been excellent over the past 30, 40 years at regulatory arbitrage, letting the Americans go first, someone else go second, and then figure out a way to kind of attract a lot of capital. And they did that with derivatives, and they did that with precious metals in the 70s. So it's not completely over yet. And we need to be less focused on what's happening right now and think a bit more medium term. And the Labour government has not forgotten about crypto. It's not polarized. It's not a political thing. It's just there's other more pressing issues at the moment.
Thank you. As of Sunday, rumor has it that Securitize, one of the leading tokenization platform, is in talks to go public via $1 billion SPAC merger with Cantor Fitzgerald. Why are some digital asset companies choosing SPACs over IPOs?
The SPAC offer an accelerated route for a listing, especially a US listing, because you have a lot of big queue of company willing to go public. This is one key benefit, and then for non-US company, that's a good way to partner with someone who opens up the US market, which is the largest market for this type of product, whatever it is, infrastructure or asset management product, investment product. It could be costly from time to time to go that route, but what's the price of time? That's the question, and that's the question we hear from companies willing to go that route. And what we see as well is that SPAC teams are pretty aggressive into scooting in for European companies, and especially US SPAC team, and they know how to sell their benefits. So they have compelling arguments, and there are many discussions right now between US SPAC teams and eligible European company. The good thing as well is that you can SPAC when you are, get acquired by a SPAC and then list in the US, starting like a few $100 million of valuation. Like you start getting interesting at 500 million, from 500 million to 1 billion. That's a compelling size for a SPAC. They look at you. And going public in the US with this with a valuation less than 1 billion, it's not as easy, and you won't be the first one, and you won't be the most visible one in front of the investor base and in front of the SEC as well. So that's a very compelling and active route right now.
Yeah, I mean, the way I think about it is there's three main ways to get listed. You have your traditional IPO, your direct listing, and your SPAC. And all of them have different pros and cons. Your traditional IPO is sort of the most glamorous, but it's the most gate-kept, right? You have bankers like Jean-Malo who kind of decide who goes in what order. And so as he mentioned, the SPAC is a way for you to sort of accelerate the process, and you put your destiny in your own hands. Direct listing is very attractive, but only to brand name recognition companies that are very large with dispersed shareholder bases. So you have your Spotifys, your Coinbases. So if you're smaller, you're less known, there's not a big retail following, direct listing is not really an option. There's only been like 10 direct listings in the last 7 or 8 years. So if you're basically the SPAC is open to a wider range of companies, which can have a negative, selection bias. You can have worse companies going that route, but both are just effective routes to get to the U.S. public markets.
Thank you.
The other part I just want to quickly mention is that why SPAC? There's just a number of companies that are not yet ready in terms of the requirements, especially pertaining to the US, of what an IPO would need. For example, 3 years of audited financials. And certain liquidity windows are only open for a period of time. And so the question is, do you go public now? Do you wait, continue to focus on growing and wait for the next window? Or is the time now for this? And SPACs offer a relatively fast, seamless route towards doing that.
I mean, when you want to IPO, essentially you have to be ready to wait, because it's a very, very long process to get IPO ready. If you want to go to the US, if you are a European company, you have an auditing requirements that is challenging, and it's massive work in order to get ready and eligible to this type of transaction, and that's why the SPAC route is interesting as well, because it's a more intimate preparation where you can do the work on your side with a partner and under the radar, which makes you be more prepared, and you can think about your business model and your go-to-market. You don't get the visibility you get from an IPO, from a branding perspective, but from liquidity and business preparation that's actually more comfortable, and companies like this aspect of the confidentiality of the preparation.
Around the same theme, we're also seeing more pre-IPO secondaries. Are these helpful tools for price discovery and cap table cleanup, or risky signals to the market?
Secondary, so that's the type of transaction that has massively exploded recently, just because, as John said, early investor needs to return money to their LPs. So that's one key area where you need to unlock some liquidity for early investor, for employees as well, and with the lack of public market in Europe, for instance. Or maybe when you are not IPO ready, as we just said, you want to alleviate this internal pressure for stakeholder and shareholder to monetize. They've been supporting the companies for a long time, and now it's time for them to bring them and to return a little bit of money. Then it's a way as well for pre-IPO company to clean up and optimize their cap table by switching early investor, often VCs, with more institutional investor, and often and ideally crossover investor, meaning investor who invest in private companies and private stock and can deploy as well on public stock. That's the crossover mandate. So they support the IPO in the companies in that route. And what we see, because we're pretty active in this, there are two ways to do it, and the best way is for management to drive that.
Right.
And they can price and put a value on their company, and they dictate the value. Well, that's a discussion, but with the banker. But they drive the value before a public transaction, and you can build a strategy whereby you do various rounds of secondaries, and you can show an increase in value. Obviously, it needs to be commensurate with the deployment of the business, but you can start building a story in order to get to the price.
Absolutely.
And to get comps when you go public.
Yeah, so we've been very active in this. We've probably done 3 pre-IPO secondaries this year alone, and I think there are structural reasons as well, which kind of tie into the first question. Prior to the downturn in our market, you had sky-high valuations in 2020, right? So you had companies pricing at 100 times earnings and just multiples now that they're just hard to make sense of. And so basically these companies have sort of been stuck, right? And they haven't been able to do much, and it's very difficult to go raise new primary rounds at drastically lower valuations. And so the sort of company arranged pre-IPO secondary is very in vogue right now because it allows this cap table cleanup, it allows some early liquidity for these investors, it allows new investors to come in who would be excited to do a public listing or an M&A, even if it maybe is below that prior round from 2020, but for them would still be a markup. So that sort of structural dynamic, I think, underpins the fact that now you have very, very active secondary markets, particularly in the big brand names that we all know, maybe like Kraken, companies like this, where the secondary markets have become fairly liquid.
Thank you. Moving on to M&As. What's driving most of the M&A deals you're seeing? Is it consolidation, a distressed acquisition, or strategic entry from TradFi players? James.
Yeah, it's a mix of all of them in reality. There's clearly some consolidation between players. There's also the purchases of that thin part of various parts of the stack. If you take a custodian, for example, they are that base layer, they're that entrance into digital assets. And on top of that, you have things like staking, payments, trading. Those type of infrastructure makes sense to be consolidated in similar ways that, for example, Coinbase has a full spectrum offering, and many of the exchanges do as well. There's the other part to it where people have built in previous cycles and they've built fantastic products that maybe had a very solid product market fit for 2020, 2021. But with the change in regulation, governance, and things that are required for the institutionalization of the space, maybe they're not quite there, but they have great tech. And so these things can be acquired not necessarily as distress, or you can acquire teams that can then build that internally into existing operations that are looking to be further institutionalized.
Now, I like what you said, talking about the companies deploying and building a specific piece of the infrastructure stack. You have great builders who've built great things, but it's difficult to, again, this is an infrastructure play, and everyone is playing with each other and needs to work with each other, and it's often difficult for these companies to raise funds to deploy on a standalone basis. And that's what's driving M&A as well. They are getting closer and acquired by the adjacent product, like staking with custody services, for instance. There are certain pieces who are not meant to be standalone, and they are a piece of a larger piecework, and that's the functional aspect of it is a key trend. And what's driving this as well is who are the players and the driver of this trend. We see that large crypto companies are pushing this because they have the right understanding of the market, they have the operational velocity, and now they have a massive pile of cash to deploy. So they are doing that, and they are deploying their capabilities beyond the digital asset or blockchain-enabled infrastructure, but to the traditional finance. And that's what I see and I find very interesting is large crypto companies eating up the traditional finance and capital market space. And they're going faster than banks. Banks will catch up, and they have an investment thesis. They have the best understanding of this market. They have slightly less cash to deploy and slightly lower operational velocity, but it's coming. The investment thesis is here. They know what to do, and I'm happy that they're getting there.
How long will it take for the incumbent financials to really start making significant acquisitions? Is it 12 months, 18 months, years?
Let's say it's difficult to say. It depends on the player, but it's a matter of months. It's 26 essentially.
But the other advantage that listed companies, banks, and others have is there's two parts. There's strategic investments and there's principal-based balance sheet investments. And on the balance sheet side, it's great for founders because whether it's a cash or a stock purchase, you're getting something that's liquid, which is an exit. And from a venture perspective, that's also great. It's great for your LPs. And I think there's a lot of consideration when a private company is buying another private company or a private company is buying part of that stack. Your equity is just getting converted into something else that is illiquid. Whereas there is that real advantages from some of the listed exchanges. Take a Coinbase that can offer its stock as part of that transaction. And sure, it may vest over X amount of years, but it's still liquid and you know it's going to be liquid. Whereas you're taking an unknown uncertainty on when a private company could, may, if, go public.
Yeah, the only thing I'll add here is I think for me, the sort of firing gun on traditional finance and crypto starting to come together was the Stripe purchase of Bridge. And I think a lot of people in the traditional space really woke up and said, okay, this is a real thing now, and we need to get on it. And I think if you look at what some of the exchanges are doing, you're seeing sort of traditional exchanges like Robinhood make purchases of crypto exchanges and move that direction, and you're seeing the vice versa as well, right? So Coinbase buying Deribit, Kraken buying NinjaTrader, right? So I think that especially the more forward-thinking, tech-enabled traditional finance venues where you buy stocks and bonds and things like that, they've all woken up to that they probably were a bit behind on this, and M&A is a really sort of efficient way to play catch-up.
Thank you. So M&A today is about strategic positioning for the next phase of digital assets. And whilst we have talked a lot about the US, which continues to dominate IPO and acquisition, Europe is taking a different path. And since we are at the European Blockchain Convention, let's take it closer to home. Tokenization, especially of equities, funds, private shares, may well represent the next generation of those same functions just delivered via blockchains. We've seen Robinhood, for example, launching their offering of tokenized equity. We've seen MasterCard back in June announcing that 50% of their transaction in Europe are now tokenized. So how do you see tokenization transforming Europe's capital market?
The way I look at it is from the banking perspective, like traditional bank, they now have understood that their balance sheet and pretty much all their balance sheet will get tokenized at one point. And as it relates to M&A, they need to make actually acquisition to be able to build the technical stack to enable their balance sheet to be tokenized and to deploy their operational businesses and capabilities to the tokenized version of their existing business. So that requires building partnerships, and banking institutions are using a best-of-breed approach where they use specific partners, and at the end of the day, they need to choose which one they need to integrate. And there is not so many eligible candidates out there. For instance, custody, you don't have thousands of custodians, and you really need this piece because that's the key enabler for your entire balance sheet. So that's another driver of M&A here.
I mean, I think for me, this is kind of a warning for Europe, right? I think, if US capital markets lead on tokenization and you with a Kraken account or an OKX account can buy effectively all US financial products in a tokenized, very easy, efficient way, you effectively see US capital markets soak up even more global capital. The way we've seen it with stablecoins, the way we've seen it with money markets, the way we've seen it with the S&P 500 ETF. So I think Europe really needs to move quickly on this because it is definitely coming, right? Robinhood, Kraken, Securitize, They haven't exactly truly tokenized stocks and bonds yet. What effectively they're doing is putting stocks into SPVs and tokenizing the units. So you're effectively trading units that are holding stocks, but those have become wildly popular already. And so if, I really think Europe needs to move quickly here, because just like how US dollar stablecoins effectively are 99% of the market, if you can buy all of the US stocks much more easily than the European stocks, that's going to be a massive competitive disadvantage.
Thank you. Let's pick up the pace a bit and go through a quick round of fire questions. Just one sentence answers, or one word for the bravest of you. So let's start with number one, start or end of cycle? Start or end of cycle, in your opinion?
Middle.
Start or end of cycle?
Middle.
It's year zero.
James?
A middle.
Pre-start?
Okay. When will we see a crypto IPO in Europe?
2026.
Okay. When will we see a crypto IPO in Europe?
Yeah, 2026.
Late 2026.
Okay.
2026 or before?
Okay. Ambitious. Who could be the next candidate to go public in Europe, starting with Jean-Malo?
Can you say it again, please?
Pardon? The next candidate to go IPO in Europe.
I won't tell.
He wouldn't tell me.
They might be in the room.
Maybe leisure.
Okay. A fan favorite, year-end Bitcoin prediction, starting with you, Mitch.
Higher than we are now.
Okay.
Where we are now?
153K.
No
There you
financial advice.
go.
How much did you say?
150.
153.
154.
Okay, thank you. That was the fun part. Let's zoom out and close on what comes next. Is this wave of listing and M&A activity sustainable, or just a short-term rebound?
I think we're just at the beginning of consolidation and public listings, and unless something monumental happens in public markets, I think we're at the beginning of this phase.
Okay, Ryan?
This is a long-term secular trend. Forget about the price of Bitcoin and the valuations of recent listings. This technology will be bought up and integrated. It's been around for 10 years, so now it's going to be regulated and allowed. So I'm very excited over the medium term.
Yeah, I agree. Long-term secular trend.
Yeah, same. And there are still a few players in the industry who have yet to accelerate on this. We have seen the IPO market opening. The VC market has been there for some time.
Right.
M&A is accelerating. We have yet to see the private equity firms now getting into it, and they are including the blockchain execution in their investment thesis. So we will see them being active very soon.
And final question, if we look 5 years ahead, what will define success in digital capital markets? Would you say more listings, deeper liquidity, or the seamless integration of tokenized assets in capital markets?
Yeah, I'll do two quick ones. I'd say more publicly listed companies, so
Okay.
retail has greater access, and more rational and consistent valuation methodologies and token pricing.
I would kind of add to the second point where token pricing really matches like underlying business economics of what they're building. and then there are more institutional managers keeping those valuations in check.
James?
I think for me, it's when we stop talking about the blockchain as a product, and really it becomes just the enabler, and the financial infrastructure has been upgraded, and we don't realize things that are tokenized are running on Rails, and those that come generations after us don't realize and just see it is the way it is.
All right. Well, thank you all to our brilliant panel for this insightful conversation. And thank you to the audience. I think if there's one clear takeaway, we're witnessing the conversions of crypto innovation and traditional finance, from IPOs to M&A to tokenization, from startups to traditional exchanges. So thank you all for sharing your insights with us today. And if you have any questions, please don't hesitate to come and meet us after. Thank you so much.
Thank you.